Hi, this is the second complete comprehensive example where we are dealing with the second method of adjustment of capital at the time of admission of a partner. The second method is calculating the capital of the new or incoming partner on the basis of capitals of the old partners. This second example sum is based on the second method, but however there will be a small variation while calculating the incoming partner's capital in this method. So let's go to the second example sum. Example sum. On 31st March 2019, the balance sheet of Madan and Mohan, who share profits and losses in the ratio of 3:2, was as follows. To the left of the screen, we have the balance sheet given. Additional information is given to the right of the screen. They decided to admit Gopal on 1st April 2019 for 1/5 share, which Gopal acquired wholly from Mohan on the following terms. First point, Gopal shall bring rupees 10,000 as a share of premium for goodwill. Second point, a debtor whose dues of rupees 3,000 were written off as bad debt paid rupees 2,000 in full settlement. Third point, a claim of rupees 5,000 on account of workman's compensation was to be provided for. Fourth point, patents were undervalued by rupees 2,000. Stock in the books was valued 10% more than its market value. Fifth point, Gopal was to bring in capital equal to 20% of the combined capitals of Madan and Mohan after all adjustments. We are asked to prepare the revaluation account, the partners' capital accounts, and the balance sheet of the new firm. So the fifth point, where Gopal is to bring in capital based on the combined capitals of Madan and Mohan, tells us that it's a second method of adjustment of capital, where we will find out the capital which is to be brought in by Gopal or the incoming partner based on the capital of the existing partners Madan and Mohan. So we'll begin with the revaluation account, prepare the partners' capital accounts, and continue with the balance sheet of the new firm. So let's go to the solution. Solution. Revaluation account. Left side debit side, right side credit side. Particulars. Rupees. Particulars. Rupees. The first point is about the premium for goodwill. The second point says a debtor whose dues of rupees 3,000 were written off as bad debts paid rupees 2,000 in full settlement. So a debtor whose dues of 3,000 was earlier written off as bad debts has given us rupees 2,000. It's bad debts recovered. We'll see how to treat bad debts recovered in the working notes. So working note 1 is treatment of bad debts recovered. The first journal entry, bank account debit to bad debts recovered account. Rupees 2,000 being bad debts recovered. The second journal entry, bad debts recovered account debit, to revaluation account. ₹2,000. This is being bad debts recovered, transferred to revaluation account. So the net result of these two entries would be to credit the revaluation account with bad debts recovered account and to add ₹2,000 to the bank balance. So let's treat it by bad debts recovered. ₹2,000. Third point, a claim of ₹5,000 on account of workmen compensation was to be provided for. There is no reserve at all in the liability side, no workmen compensation reserve. So we'll have to create a liability. So to workmen compensation claim account, ₹5,000. The fourth point, patents were undervalued by ₹2,000. We need to increase the value of patents. So by patents account, ₹2,000. It says stock in the books was valued 10% more than the market value. So let's do the working notes to calculate the actual value of stock. Working note 2, calculation of actual value of stock. We can use the unitary method. So the current value which is ₹33,000 is actually 110% of the value. So to get the actual value, which is 100%, let's do the unitary method. 33,000, the actual value. 33,000 rupees multiplied by 100 divided by 110. So we have that the actual value of stock is ₹30,000. So as against the book value of 33,000, the actual value is only 30,000. So let's post this in the revaluation account. We need to decrease the value of stock by 3,000 rupees. The greater total on the debit side, ₹8,000. There's a loss by loss on revaluation, transferred to partners' capital accounts. So we have Madan and Mohan. Total loss 4,000 rupees divided in OPSR 3:2. 2,400 against Madan and 1,600 against Mohan. So this is a revaluation account. Next, let's go to the partners' capital accounts. Partners' capital accounts. Left side debit side, right side credit side. We have particulars, a column for Madan, a column for Mohan, and a column for the new partner Gopal. Again on the credit side, particulars, a column for Madan, a column for partner Mohan, and a column for Gopal. We'll begin by bringing down the balance of the capital accounts. By balance brought down 60,000 against Madan, 40,000 rupees against Mohan. We'll transfer the loss on revaluation to revaluation account. The loss on revaluation 2,400 for Madan and 1,600 for Mohan. 2,400 and 1,600. There is a general reserve on the liability side of the balance sheet. We'll distribute that by general reserve. $10,000 in OPSR 3:2. So 6,000 for Madan and 4,000 for Mohan. Gopal is bringing in rupees 10,000 as a share of premium for goodwill. But the very first sentence says they decided to admit Gopal on 1st April 2019 for 1/5 share, which Gopal acquired wholly from Mohan on the following terms. So the sacrificing partner is Mohan and not Madan. So the entire premium for goodwill of rupees 10,000 will be credited to Mohan's capital account. So by premium for goodwill, account, the entire rupees 10,000 credited to Mohan's capital account. We need to do the calculation for the amount of capital which is brought in by Gopal. We'll put the partners' capital accounts in the first half of the screen and do the working notes at the bottom half of the screen. So the next working note 3 is calculation of capital brought in by Gopal. So step 1, adjusted capital of Madan and Mohan. In the case of partner Madan, the total of the credit side comes to 66,000 rupees minus the total of the debit side 2,400 rupees. So we have 63,600 rupees as Madan's adjusted capital. Mohan's adjusted capital, the total of the credit side is 54,000 rupees minus the total of the debit side 1,600 rupees. So adjusted capital for Mohan is 52,400 rupees. Now, as per the question, in the 5th point it says Gopal was to bring in capital equal to 20% of the combined capitals of Madan and Mohan after all adjustments. So this is a slight variation in the second method which I mentioned at the beginning of this video. It does not say that Gopal is to bring in capital equal to 20% of the total capital of the firm. It says instead that Gopal was to bring in capital equal to 20% of the combined capitals of Madan and Mohan, not 20% of the total capital of the firm. So this is a variation in the second method. So we'll first step 2 is to find out the capital which is to be brought in by Gopal. We'll add up the adjusted capitals of Madan and partner Mohan, and 20% of this is the capital which has to be brought in by Gopal. So the capital to be brought in by Gopal is 23,200 rupees. So let's insert this in the partners' capital accounts. By bank, $23,200. We'll balance the accounts. To balance carried down. 66,000 greater total for Madan minus 2,400, we have 63,600. In the case of Mohan, 54,000 greater total minus 1,600, 52,400. And the case of Gopal, 23,200 rupees greater total. Balance carried down is also 23,200 rupees. So this is the partners' capital accounts. Let's go ahead and prepare the balance sheet. Balance sheet as at 1st April 2019. Left side, liability side. Right side, asset side. We'll begin with the liability side items. Creditors, 28,000. There is no change in value. The general reserve has been distributed. It will not appear on the reconstituted balance sheet. Employees Provident Fund, liability. Rupees 22,000. No change in value. As per point 3, there is a workman compensation claim of rupees 5,000. So workman compensation claim 5,000 rupees. Let's insert the capital accounts of the partners. Madan, Mohan and Gopal. We'll check out the capital balances from the partners' capital accounts. 63,600, 52,400 and 23,200. For Madan, 63,600, Mohan 52,400 and Gopal 23,200. Let's get the total. 1,39,200 rupees is the total of the partners' capitals. We'll continue with the items on the asset side. First item, cash at bank. The opening balance is rupees 10,000. The capital which is brought in by Gopal was 23,200 rupees, plus the premium for goodwill brought in by Gopal, which is 10,000 rupees. And as per point 2 here, rupees 2,000 was recovered as bad debts recovered. So plus another rupees 2,000. So the total of the bank, 45,200 rupees. Debtors, there is no change. Original figure 65,000 less provision 5,000 rupees. Outer column 60,000. Stock, we found out that the correct value of stock was 30,000 rupees. Patents, it says patents were undervalued by rupees 2,000, so the correct value is 59,000 for patents. Let's check if the balance sheet tallies. The total of the liability side, 1,94,200 rupees. Total of the asset side is also rupees 1,94,200. I'll remove the split and we can view all the accounts together. So this is the first account, revaluation account, which was prepared. Resulted in a loss on revaluation of 4,000 divided between old partners in OPSR, followed by the partners' capital accounts, and then the balance sheet. Working notes at the end of the sum. The first working note was for the treatment of bad debts recovered. The second working note was for calculation of actual value of stock. And the final working note was to calculate the capital which is brought in by the incoming partner Gopal.